Okay, good afternoon everyone, and welcome to Forager's first webinar of 2018, where we will be discussing investing when animal spirits are running. I'm Alex Larkman, and I'm the Business Development Manager at Forager. Today's presentation deals with bull markets and some of the lessons learned in the past that has shaped the discipline that Forager applies today in its approach to investing. If you're viewing this live today, you can send us in questions during the course of the discussion. We have set aside some time at the end of the session to answer them for you. But firstly, some important compliance information. Sorry, that was me. We don't know anything about your personal financial circumstances and haven't taken anyone's personal financial situation into account when preparing this information. Everything you see or hear today is intended as general in nature and does not take your personal situation into account. So without further ado, I will run through the timing today and then introduce you to our panel. The presentation and discussion itself will run for about 35 minutes till 1:35, and then we've got some time for questions. So next, I'll go through the team. Firstly, welcome Steve Johnson, our Chief Investment Officer at Forager. Hi, Steve.
Hi, Alex.
We're also joined by Gareth Brown, Senior Analyst on Forager's International Fund. Hi, Gareth.
Hi, Alex. Hello, everyone.
And from the Australian Fund, Alex Shevelev.
Hi, Alex.
And now I'll leave you with the team for the discussion.
Thanks a lot, Alex, and welcome everyone. My name's Steve Johnson, as Alex just said, and I'm going to take you through our little presentation today. I actually think it's a really important topic because we spend a lot of time talking about the psychology needed to take advantage of bear markets and down markets and the way that we need to invest and perform in those markets. But the reality is that the vast majority of time we spend our lives in markets that are going up. If I look back over the last 20 years that I've been actively investing in stocks, we've probably had 3 that you would call particularly bearish, and the rest of the time either modestly going up or going up quite rapidly. And we've got this quote that we used in the last quarterly report up on the screen here, and I think it's a really important one. These environments of rising markets tend to create envy, and JP Morgan said it best, nothing so undermines your financial judgment as the sight of your neighbour getting rich. And it's what we want to spend some time talking about today is how do you navigate these up markets? How do you avoid doing stupid things? And I think you can do as much damage to your portfolio in these bullish markets as you do in the negative ones. Before we get into some tips though for navigating it, I thought we'd ask the question first, what actually defines a bull market? And Gareth, I'll hand this over to you. What's your definition?
I think there are 2 main signs in my opinion. First, you can see it in the numbers. If you move on to the next chart, that shows the stock market, the MSCI index, which is a global index across the world over the last 50 years. And just to explain, the line that I'm told is a bronze colour, the straight line, that is the average return, which equates to about 6.5% per annum compound. That's
colourblind Gareth telling you it's Forager bronze.
Over the last 50 years. And then the squiggly line is the way the stock market has actually moved. And what you can think of as a bull market is a time when the returns today are eating into future returns, or in some cases recouping past lack of returns. And you can see that clearly with the 3 periods that we've highlighted here, especially that 80s bull market was recouping from a very poor returns in the 70s, and others have moved ahead of trend.
So I think that 6.5% per annum, which is the average return over the past 50 years, it's actually been pretty consistent if you go back over 100. And we tend to sit there and say, well, any year where you earn more than that 6.5%, you're borrowing from the future or you're recouping from the past. And any year where you earn less, you're probably saving something up.
And the other sign for these kind of markets is the psychological aspect. Everyone seems to be making money. It's playing on everyone's psychology. And fear and concern, for the most part, from the point of view of an individual investor, relates more to fear of missing out rather than fear of actual loss.
What's the biggest, I guess, sign for you? Do you focus more on the investor behaviour in terms of determining your own investment strategy, or is it purely a numbers-based thing?
A bit of both, I think.
Something that you see Jeremy Grantham of GMO talk about a lot is multiple expansion in bull markets, and it's one of the main things that he looks for as a sign that things are getting bullish. But we've got another chart here, and if you look at it, two of those bull markets that Gareth highlighted, this is the S&P 500, not the global index, but it illustrates the point really clearly. Two of the bull markets are really obvious in terms of multiple expansion, and one of them is not. And Alex, I'll bring you in here. What do you think about focusing on multiples as a sign that things are getting expensive?
Well, Steve, it tells us that bull markets can be more than just about the multiples. So the multiples are applied to earnings, and those earnings themselves can at times be greater than you would expect over the long term from a given company, and therefore over the index as a whole. So if you look through the 2003-2007 period, you'll actually see that multiples didn't actually go up like they may have in the 90s and more recently, but earnings did, and that multiple applied to higher earnings gave us that particular bull market. When those earnings reduced back to a more normal level, you had the correction.
Yeah, if we look back at that period, you had, particularly in the financial sector, a lot of businesses using huge amounts of leverage to create unsustainable profits. And it's a really good example, I think, of this is a trickier type of bull market, the one that's just multiple expansion. I think the multiple expansion is easy to see. You're not going to find a lot of things out there that you want to invest in at the right price. I personally made some mistakes through this up to 07 period because there were a lot of stocks out there that were trading on what looked like attractive multiples at the time. And you know, I lost money in a few of those where the earnings themselves turned out to be very, very flaky. So I think that earnings bull market tends to be on the back of a very strong economy. They can be very risky ones as well. This is just blowing up the last 12 months of that long-term chart that we had up before. Again, it's back to the global index, showing a pretty strong run-up in prices up until the past 2 weeks. Two questions here for you. That longer-term picture, the past 12 months, are we in a bull market? And secondly, does the past couple of weeks change your view on what type of environment we are? Alex, I'll come to you first.
It's, and maybe blowing up is an interesting way to put it, but in the last couple of weeks, you've seen a lot of commentary about just how bad it's been. And if you look at that chart, you'll see we're probably back to somewhere close to where we were in October or November, and back to that line. That's, if you were thinking back in October and November that the market was overvalued, you'd probably make the same comments now. There are definitely parts that are, and there are probably other parts where we're finding some opportunities that are not.
And Gareth, globally, you spend most of your time looking around the world. Is the story the same?
Yeah, for 5 years, I would say we've been in a pretty decent bull market, although one that, as they say, climbs a wall of worry. As for the last week or so, I don't know yet. I mean, this could be the start of a change to a bear market. It could look like this. It could just be the typical shakeout that you get in bull markets, like earlier in 2016. So we will see.
I'm glad you both said that, because the rest of the presentation is about investing in bull markets, and we would have had to cut it off early if you thought it wasn't a bull market. And fortunately, the people who have tuned into this webinar, 85% of them also think we're in a bull market. So we will proceed with how to navigate this type of environment. We split the rest of the webinar up into 3 key areas that we think people should think about. And the first of those is avoiding the bubble-like behaviour. Now, not all bull markets are bubbles, but all bubbles happen in bull markets. They tend to create the prerequisites. And the first thing that we want to talk about here is giving those excesses a very wide berth. We've got a quote up here from Charles Kindleberger, who wrote a very famous and very old book on manias and panics. And you know, the behaviour that he described hundreds and hundreds of years ago has been repeated many times since he wrote that book. And he makes some really good points here. A bubble involves the purchase of an asset, usually real estate or security, not because of the rate of return on the investment, but in anticipation that the asset or security can be sold to someone else at an even higher price. The term the greater fool has been used to suggest the last buyer was always counting on finding someone else to whom the stock or condo apartment or the baseball cards could be sold. It's a really key point here. The bubble is really about when the price gets divorced from the income you are expecting from that investment. Gareth, what are some of the kernels, I guess, or how do these bubbles get started?
I think the bubbles are never complete flights of fancy. Kindleberger points out elsewhere in that book that most bubbles start out rationally. They start out with a real change and a real opportunity. So you think back to the Japanese bubble of the property and stock bubble of the 1980s. That was built on the back of massive industrialization in Japan in the 60s and 70s as it was recovering from World War II. The tech boom of the late 90s and early 2000s, that was, the story was the birth of the internet, which did change all our lives. So it was a good idea taken too far is probably the right way to put it.
I mean, Gareth, a good example of this is Bitcoin and cryptocurrencies as a whole. You have potentially some kernels in there of problems needing to be solved. So debasing of fiat currency. You've got blockchain as a reasonably efficient system for solving particular challenges. You've got a broadly inefficient payment system in some parts of the world. But the market, especially on the crypto side, you've seen very quickly run to a point of euphoria. So we've started with this kernel and we've very quickly got to the top of that chart you see now before you. And that was 2 months ago. And now we're, I would say, somewhere closer to panic. So it's important to note that some of the asset classes, some of the sectors and some companies specifically go through the bubble cycle we've pointed out here very quickly, and others, and on average, equities slower.
I actually find this diagram really useful because it describes the anecdotal things that you see out there. And one of the really big things for me is when people start using rationale for buying something that can be used at any price. So it doesn't matter whether Bitcoin's $500 or it's 1,000 or it's 20,000. You can use those same bull arguments to justify the price, and therefore the price can go up towards anything. Gareth, you've got a sector, I guess, at the other end of the slippery slide there.
The oil sector and the oil services sector is really at the opposite end of the spectrum. We probably reached the point of despondency and depression 12 months ago. We're coming out that, and we're at the hope phase now, or the relief. It had its wild times in the past, but it's been the opposite lately.
Yeah, it is still an interesting part of that cycle though, because I think there's still a lot of disbelief about whether it is sustainable or not. And you often see that in the early point of the turnaround. Bringing it back to the stock market, if you look at this diagram that's up on the screen at the moment, where would you say we are in terms of equity prices at the moment? Gareth first?
Yeah, I don't like putting the whole stock market into one bucket because I think we're, as you've already seen, there are different things in different categories right now. But on average, we're probably somewhere past the excitement phase and into the thrill phase. Now, of course, that doesn't mean we are heading into a bubble. It may not happen, but that's what it might look like if we do into one.
I agree with Gareth just in terms of where we are more broadly on that chart. But it's interesting to note some of the smaller pockets, sectors, individual stocks that are pretty much at that euphoria point as well. And a good example of those is some of the smaller tech companies listed on the ASX. Now, we don't have very much tech exposure in Australia, and I think people see the larger tech companies in the world, the profitable ones mostly, affecting many aspects of their life. And they get excited about tech as a whole and excited about domestic tech companies that come along and at times sell a story. They sell it very well, but they have announcements with large companies, contracts that sometimes don't turn out to exactly be contracts, and very big revenue numbers. Now, the chart in front of you there has a couple of these that we wrote about in the quarterly. Digital X fits in well with one of the with the crypto we spoke about earlier. much like crypto back then, the stock ran up very hard and deflated just as quickly on the back of crypto declines. Buddy's another one that seemed to have a product that was reasonably commoditized, but made mention of the Internet of Things and the many wonderful applications of their product in the world, and ran up also very sharply. It's interesting to see, if you look at that chart, though, the price change almost better measured in multiples than in percentages, and especially for the ones I've mentioned, a couple of others, you might well see an unwind to those price changes.
Yeah, it's pretty clear we've got something of a bubble in that small part of the market, and there's actually a lot of red flags there that people should be aware of and have broader applications in this little space. And I actually wrote up Get Swift in our last quarterly report as a stock that I didn't think justified its valuation at all, and one where the promoters of that stock have been able to capitalise on the hype around it by raising a very large amount of capital. And I didn't spend a huge amount of time on the stock, and as we'll see on the next slide, it has come unstuck. But people said to me, well, how could you spend a small amount of time and come to the conclusion that this stock didn't have a lot of substance to it relative to the valuation? And there's a few really important red flags. You already touched there on the buzzwords. So, you know, Internet of Things, software as a service, they love rolling these types of things out. For me, using other companies' brands is a really well-worn path. So putting out announcements like Yum Brands is signing up to us, Amazon, and they're not it's not a one-off agreement or anything. These things are coming out every second week with a company's brand name on it. And then the cashing in on that is really important as well. So we've got our stock price up. When you see people either start to sell their own shares or raise capital using that high price, it's really important. The old Get Swift is currently suspended and has been for a couple of weeks while it tries to explain some of its disclosures to the ASX. And as I said, they've raised a lot of money, so it's not going back to zero, but I think when it does come back on the boards, it will be a very good example of the money that can be lost playing in this part of the market and really chasing the returns that you've seen other people made. Another thing, and you often see this in bubbles as well, I just come back to it because I forgot about it, but they're capitalising on the success of other businesses. So, you know, Atlassian's now a $10 billion company. Aconex just got taken over at $1.4 billion, and all of these wannabes come along and say, well, we're the next Aconex or we're the next Atlassian, and I think that, again, is another really big warning sign. So avoid this very speculative behaviour. Make sure that your investment is based on income that you expect to return from the investment rather than the share price going up. I think as value investors, we tend to find this piece of bull markets relatively easy. We tend to be skeptical by nature and give those things a wide berth. The next section we're going to talk about, I think, is a lot more difficult, and that is, if possible, stay invested. Now, people have probably heard me talk about this over the years, but I think it's easy to forget the very strong case for remaining invested in real assets over long periods of time. We had that chart up earlier. Owning stocks over a long period of time, you've earned a 6.5% return. You want to be really careful about cashing in those chips and moving from an investment that gives you long-term 6.5% returns into one that gives you nothing. I've used that language, mostly invested most of the time, and I think it's actually important. We are going to be in bullish markets for most of our lives, or at least markets that are going up, and I think it is important to try and stay invested where you can. I'll come to you, Gareth. What are some of the things that you think about in terms of, I guess, looking for investments when the whole market is not particularly cheap?
I think it's important to remember here that your portfolio doesn't have to look like the market. The chart in front of you now is the biggest bubble that has occurred in my investing career, which was the NASDAQ bubble, which was really a global technology bubble, and it happened at the same time as a US blue chip bubble. While that was some of the most egregiously overpriced companies I've ever come across, at the time there was a lot of opportunity in old economy stocks. So even large caps here in Australia, but definitely in small caps, anything that didn't have the technology banner attached to it, US as well. So it was actually a really, really good time to be a value investor. I remember when I was working at the Commonwealth Bank, I had one of my colleagues in my ear calling me a dinosaur aged, I don't know, 23 for not buying DAVnet. And at the time, my largest position was a liquidating oil and gas trust. And even if the price of oil had gone to zero, my bank guaranteed return of capital returns got me into double-digit type returns. And, you know, it was a wonderful time to be a value investor. 2007 behaved quite differently to that. But the first thing is to make sure you're out there and checking and finding opportunities if they still exist.
Yeah, and you often find in these bubblish environments, it sucks the oxygen from elsewhere. So everyone wants to own what's the latest and the hottest security, and that means they don't want to own other things, and that can create opportunities there. One thing I just want to throw in here is the importance of sticking to your strategy and I guess remaining true to your objectives. So, you know, we constantly sit here in our business and say we are looking to buy real businesses that are going to give us double-digit returns over a long period of time. And as markets get more expensive, that is going to be harder to do, but it's important to stick to that process. And you want to look for stocks that are in your circle of competence. Can I understand them? You want to look for stocks that you can value still, i.e., I know or I can make a reasonable estimate of how much cash flow is going to come out of this business, and I can put a number on that. And then I can purchase that security at a margin of safety. And this doesn't change for us whether we're investing in a bull market or a bear market. The overlap between all of those things, it might get smaller in bull markets, but it's really important that you maintain your discipline and you stick to that strategy. And I touched earlier on some mistakes through that period leading up to 2007. And another one for me was the whole concept of, you know, buying lower quality businesses on, say, 8 times earnings because the market is trading on 15. Now, if you think 4 or 5 times earnings is the right number for that business, you need to stick to that even in bull markets. Alex, one thing I'm sure everyone finds difficult is actually just rustling up the energy to look for ideas. Gareth's already touched on, you know, the whole market is not the opportunity set that you have to stick to. You can get out there and find opportunities, but it is harder and they are less frequent than they are in bear markets. You've joined the team fairly recently, but are coming up with quite a few new ideas. How do you maintain that energy?
So I think there's always something to look at, and even in expensive markets, we've got to look at the total number of stocks and the sectors involved. Not all of those are going to be correlated. Some, especially in bull markets on stock-specific factors, can be sold down quite substantially. And the other thing that kind of gets me going in terms of looking at new stocks is, look, there's going to be stocks in the market over the next year or so, over the next 3 years, that will rise substantially. How do we go about going and finding those, and where are they likely to be in the market? It's also interesting at that point to say, even if you look at something and it's not quite the right price for you yet, you haven't got the margin of safety required, it's not time wasted. It's time that you've accumulated, it's knowledge that you've accumulated on particular stocks. And when that time does come around, and it can come around quite quickly, you've then got the ability to act quickly. Yeah,
that diagram that we looked at earlier, the cycle of bulls and bears and bubbles, it happens on a market-wide basis. It happens on an individual stock basis too, and often those two things line up fairly neatly with each other, but in quite a few cases they don't as well. So you can have the pessimism and despair going on in a certain sector, like Gareth talked about, or you can also have it in individual stocks as well. And I actually think this is a really important point, just to stay proactive on the idea generation front. I think it's easy to get despondent. It's easy to think you're just going to wait for the next bear market. You've got to get out there every day and keep looking for ideas that, yes, you're staying disciplined, but keep looking for those ideas that meet your hurdle rates of return. Alex, we might talk about a couple of those new ideas that are in the portfolio at the moment, and hopefully shed a little bit of light, I guess, on where they're coming from in what is a fairly optimistic market.
The first one we can chat about is Freedom Insurance, which is an insurance distribution business. Now, it's halved over a number of months, and despite being in a bull market type scenario, there were reasons for the stock having come down that far, and the business distributes insurance. It has some interesting accounting and cash flow issues to get your head around. And I think in those sort of situations, the more complex ones, the smaller ones, the illiquid ones, even though you're in a bull market, you can have opportunities. CSG is another one of those. It's a print management company. And again, the decline there has been even more substantial, from close to $1.80 now to closer to 30 cents. There's been a couple of recent issues in the business. And again, on a stock-specific basis, we're able to get opportunities to purchase a substantial position there.
It's not uncommon when people are valuing, on the upside, valuing these businesses on metrics that are not necessarily financial, that they do the same on the downside. It's not meeting those momentum criteria, therefore I don't want to own it at any price. And you can pick up opportunities like these two, what we think are quite attractive ones, even in a market that's very positive. Gareth, internationally, are we finding much of the same thing? And have you got an example?
Yeah, we've bought a few investments over the last couple of months. One of them, Technicolor. It's cheap for a variety of reasons that are company specific. If you have a look at the chart for this stock going back to the tech boom 18 years ago, it's down more than 99%. It's enough to make a chartist puke. It's listed in France, even though its business is all around the globe. I think it's a little bit maybe misunderstood in that context. And it's highly complicated. It's got multiple parts, and some of those parts really are, it's right to be pessimistic about them. We think they have some issues they need to work through there. We just think the market's taken that concept too far and made the stock too cheap. Another area that we are finding a bit of luck in at the moment is in UK. It's a whole geography that's come under pressure in the post-Brexit world. And we're finding things at both extremes of quality there. We recently bought a stock that I won't name, but we will mention it in a future quarterly report, that is extremely high quality, one of the highest quality businesses we've ever owned at a reasonable price. At the other end of the spectrum, we have something like Dolphin Capital that owns a bunch of land to develop into resorts that has been, I would say, mismanaged for quite a long time until recently, and that is liquidating, but it's so cheap that that's why we own it.
I'd even throw the banks around the world, perhaps accepting Australia and Canada from that, but across the US and particularly in Europe, I think the whole sector is maligned. People are convinced that they're never going to get back to earning attractive rates of return on their capital. And I think as the cycle plays through, these businesses, some of them which are very, very good franchises, will end up earning decent returns on their capital, and you're buying them at pretty big discounts to book value in some cases at the moment. So we own Lloyds, which is in the UK, and we own Ubi Banca in Italy. I think they're really good examples of, particularly that high quality stock that you just talked about, Gareth. In a perfect world, in a deep bear market, you're not buying the things that are giving you the 10 and 12% returns, because you've got opportunities that are giving you 20. But I think in these bull markets, it is important to keep saying, if I'm confident about this 10% return here, then it is worth me having in the portfolio, rather than ending up with a portfolio that is 20% cash. And it is a fine balancing act. We're going to move on to the final section now, and it's going to sound like it's going against everything that I have just said. But if you are turning over lots of rocks, so you're getting out there and you're working really hard and you're not getting pessimistic, you're turning over lots of rocks, you're sticking to your process, you're sticking to your hurdle rates of return, and you're still not finding enough to fill up your portfolio, then I think that flexibility and the willingness to hold cash are really important. It's been a feature of both of our funds over the past few years, more so internationally than in the Aussie fund, although we have had elevated cash at times in the Aussie fund. I think that diagram that I had up earlier about everything overlapping and you being able to invest in the middle of it, you want to go and hold more cash when that margin of safety drifts away from the other two things. Okay, I can value the businesses, I'm finding them in my circle of competence, I'm just not finding them with enough margin of safety to put into the portfolio. Gareth, on the international side of things, we've held on average a lot of cash for a long period of time. How do you think about the cash weighting in the portfolio and weighing up being fully invested versus having cash on the sidelines?
I think if you look at that chart there with our average cash weighting over the last 5 years, you can ignore the first 18 months, 2 years even as we were getting invested. But the last 2/3 of it, basically ebbing and flowing with the markets. And I think you can expect that over time. Our intention is to be as fully invested as possible when there's a lot of volatility and a lot of fear around. We saw that early in 2016. We're seeing maybe hints of that now. And then at other times, the cash balance will go up. So I think of cash as two things. I think of cash as discipline. We're putting it to work when the rates of return are there. When they're not available, we still want to keep our sell discipline on things that have reached fair value. You'll see cash naturally march up. I also think of cash as weaponry, as optionality. So it's some investors view cash as laziness. I view it as preparedness, and it's a tool we want there when panic hits and we're ready to pounce. And we've seen a little bit of that in the last 2 weeks.
And Alex, I've burdened you in the Australian fund with A, starting with some fairly high cash weightings, and B, a pretty good chunk of the portfolio that has performed very well over the past few years and was probably reaching fair value. How do you think about cash weighting, and what do you think it's going to look like in that fund in future?
Well, it's better than having no cash and an underperforming portfolio, so that's been good. But we are completely comfortable holding cash in the Aussie fund as in the international, and we will over time also be mostly invested most of the time. There's obviously a couple of stocks in our portfolio that are reaching maturity. We've written about some of them. It's also worth pointing out that really when you're looking at a portfolio of 20, 25 stocks, it's only a small handful of stocks that would reduce your cash weighting from a 25% level to 10 to 15.
So get out there and find them.
Yeah. So look, it is a really important tool. It's something we've been adamant about in our mandates. Both of them say we can have 0 to 100% cash. I hope it never comes to 100% cash, but the really important message that we're trying to send to potential investors by having that flexibility is that we are going to use it in extreme examples, despite my strong preference for investing people's money in equity markets most of the time. Just one little caveat there for anyone who's new to Forager. We do think that 10 to 20% level of cash is perfectly normal, and the bottom end of that range is close to fully invested for us. It's really important that we have something on hand that we wake up in the morning, something dramatic's happened, the company's doing a capital raising, whatever it is, we've got the ammunition to get out there and participate in those things. So that's summarizing up our advice on investing in bull markets. 1, avoid the excesses completely. 2, if possible, stay invested. And 3, be prepared to hold more cash if that doesn't quite work out. I really liken this type of environment. I watching the world's best sports people, and I really enjoy watching when things are not going well for them. When they're playing against an opponent, you think about a Roger Federer or a Serena Williams or a Tiger Woods at his best. They're playing against an opponent that's playing out of their skins. They're serving in a way you can't possibly get the serve back. And these people just find a way to stay in the game. I'm going to make sure I hang on to my own serve. I'm going to try and get into the tiebreak at the end of the set. I know that I'm not going to win through these periods where the person is playing out of their skin, but I want to stay as close as I possibly can. And I think it's really important to try and do the same thing through these periods in the equity markets. You can chuck your toys and just go to cash and say there's nothing out there for me to invest in, or you can try and put together the best portfolio you can. You can hold elevated levels of cash without going to extremes about that. You can stick to better quality businesses in an environment like this, except that you may not get the 20% returns of the past, but those returns are going to be lower. You try and get that balance right, and then when the markets turn and when the opportunities present themselves in a scale, that's when we get out there and make the excess return. One final point with regards to all of that, I think going way back to that first quote that we put up with JP Morgan, it's really important that you are prepared to watch other people getting rich while you're sitting here doing sensible things